October 2023. A woman in Columbus, Ohio opens her banking app on a Tuesday morning. She hasn't bought a coffee outside her apartment in 47 days. She canceled Netflix in August. She brought lunch to work every day this month except one. Her balance is $12 lower than it was at the start of October. She stares at that number for a while. Then she closes the app. I started this investigation expecting to find a story about bad habits. What I found instead was a paper trail, policy documents, internal bank memos, Federal Reserve survey data, and one 2019 audit finding that nobody in the personal finance space ever seems to quote. This is that trail. On the morning of March 14th, 2023, a budget app screenshot circulated in a personal finance forum. The user had color-coded every expense category. The discretionary column was nearly empty. The fixed cost column took up most of the screen. The number at the bottom, $333, left over per month. After the basics, that figure wasn't an outlier. For a household earning $42,000 a year, close to the median income for single-person renters in most mid-size American cities in 2023. The Federal Reserve Survey of Consumer Finances found that fixed essential costs averaged roughly $38,000 annually. Housing, transportation, insurance, debt service, phone, utilities, the basics. That leaves $4,000 for everything else. $333 a month. Now imagine the woman in Columbus. She cancels a $15 streaming subscription in the framework every budgeting app uses. She just created $15 of savings. That $15 goes somewhere. Maybe it reaches savings. But more often, one of two things happens first. Either it gets absorbed by deferred maintenance, the car repair she'd been postponing, the dental appointment she'd been avoiding, the winter coat that finally gave out, costs that were already real, just not yet due. Or it disappears because the floor itself moved, the lease renewed, the insurance premium adjusted. The grocery bill for the same 12 items cost $23 more than it did the same month last year. She didn't change her behavior. The inputs changed. For her specifically, that canceled $15 subscription almost certainly didn't reach savings. The floor had already moved to meet it. This is what economists call a cost floor ratchet, and understanding it requires understanding not just what it does, but when it was built and by whom, because it didn't appear on its own. The ratchet started moving in a specific direction around a specific decade. And there's a paper trail. The next document on it is dated 2018, and it should have been front-page news. In 2018, researchers at Harvard's Joint Center for Housing Studies published a finding that should have been front-page news in every personal finance publication in the country. It wasn't. The finding, between 2001 and 2018, the share of American renters spending more than 30% of their income on housing, the threshold the federal government itself defines as cost-burdened, rose from 41% to 47%. Among lower-income renters, that figure was above 70%. The mechanism behind that number isn't mysterious. It's documented in zoning board minutes, in city council votes, in lobbying disclosures, in most high-cost and mid-cost American cities. Land use restrictions, minimum lot sizes, single-family zoning, permitting backlogs, height limits constrained housing supply in ways that kept prices elevated. These restrictions were not passed by accident. They were supported by existing property owners, for whom rising values represented rising net worth, and opposed by renters and prospective buyers, for whom rising costs represented a rising floor. The distributional effect is clear in the data. Homeowners in those markets gained wealth as their asset appreciated. Renters in those markets saw their fixed cost floor rise often faster than their wages. That floor, once raised, doesn't come back down. each lease renewal, each household formation. Each move locks in the new level. Economists have a word for this: the ratchet effect. And once you see it, you can't unsee it in the data. For the woman in Columbus, her lease renewal isn't a personal negotiation. It's the downstream consequence of a zoning vote she wasn't in the room for. But housing is only the first mechanism. There's a second one that operates even when housing costs stabilize, and this one came with an even cleaner paper trail. The document has a subject line. In 2013, an internal memo circulated at one of the 5 largest American retail banks. It was later obtained by journalists through a regulatory disclosure request. The subject line: optimization of overdraft fee revenue by account tier. The memo detailed something the bank had measured carefully. Lower balance account holders generated a disproportionate share of overdraft fee revenue, and that revenue could be increased by adjusting the order in which transactions were processed, specifically by clearing larger debits before smaller ones, which increased the probability that multiple small transactions would each trigger an overdraft fee rather than one. This is not a fringe practice. The Consumer Financial Protection Bureau documented it across multiple institutions. In 2021, the CFPB reported that overdraft and non-sufficient funds fees generated approximately $15.5 billion in revenue annually, more than the GDP of Iceland, extracted almost entirely from people with under $1,000 in their accounts, with the bulk paid by a small fraction of account holders, concentrated in the lowest income bands. What does this have to do with saving? When you are operating near the edge of your income, when $333 a month covers everything that isn't a fixed cost, an unexpected $35 overdraft fee is not an inconvenience. It is a budget event. It either gets covered by the thin discretionary margin, or it gets covered by debt. And when it gets covered by debt, the monthly payment that results becomes a new fixed cost, a new floor. The debt floor spiral works like this. An unexpected cost creates a gap. The gap gets covered by high-cost credit because that's what's accessible at this income level. The credit creates a monthly payment. The monthly payment raises the floor. A higher floor makes the next unexpected cost harder to absorb without creating another gap. Repeat. This is not a moral failure. It is, as the CFPB's own data shows, a mathematically predictable outcome of the fee structure the banking industry built and which regulators allowed. For the woman in Columbus, that $12 gap at the end of October may not have been a spending decision at all. It may have been a $35 overdraft fee, reordered into existence by an algorithm optimized for exactly her account balance. But there's a third mechanism, and this one operates not on the cost side, but on the income side in a way that makes the floor problem significantly harder to escape. Here is something the standard budgeting framework assumes that isn't true for roughly 36% of American workers. It assumes income is a stable, predictable horizontal line. For hourly workers, gig workers, contracted workers, and commission-based workers, a share of the workforce that has grown substantially since 2000, income is not a line. It's a wave. Some months are higher, some are lower, and the variation is not small. Federal Reserve data from 2022 shows that 30% of adults reported significant month-to-month income variation, with swings averaging more than 25% of monthly income. Income goes up and down. Costs don't. That gap, the mismatch between when money arrives and when bills are due, is where savings go to die. Here's the mechanics. In a high month, the surplus feels like evidence of progress. The buffer grows. In a low month, fewer shifts, slower gig demand. A gap between contracts the fixed cost floor does not move to accommodate the shortfall. The rent is still due on the 1st. The debt payment is still due on the 15th. The gap has to be covered somehow. If a buffer exists, the buffer covers it. If not, debt covers it. and that debt becomes the floor for the next cycle. What I expected to find when I started this investigation was a story about individual behavior, people not saving in high months, spending what they shouldn't, failing to plan. What I found instead was a 2022 J.P. Morgan Chase Institute study that tracked actual transaction data for 2.5 million customers. The finding: households with volatile income saved at substantially lower rates than households with stable income, even when controlling for average income level. Same average dollars coming in. Different timing. Dramatically different savings outcomes. The timing is the mechanism, not the discipline. For the woman in Columbus, if her hours varied by even 20% month to month, her $333 margin didn't just shrink in low months, it went negative. The math didn't require a single bad decision. But there's something the income data showed that I didn't expect. Something that makes the volatility problem even harder to solve, and it operates at the cognitive level, not the financial one. In 2013, Senthil Mullainathan and Eldar Shafir published a study in Science that measured something most personal finance content never acknowledges. Managing financial scarcity consumes cognitive bandwidth. Specifically, it consumes enough that the effect is comparable to losing a full night of sleep, or to a 13-point drop in IQ performance on standardized tests. This wasn't a survey of self-reported stress. It was a controlled experiment with measurable cognitive outcomes. Here's what that means practically. A person operating with a $333 monthly discretionary margin makes more financial decisions per day than a person with a comfortable buffer, because every purchase requires a calculation that the person with a buffer doesn't need to make. Can I afford this? What does it do to the rest of the month? Is this the expense that breaks the margin? By the end of the day, the cognitive resources available for careful, longer-term planning are measurably depleted. The researchers called this tunneling. Scarcity focuses attention on the immediate fire this week, this month, at the cost of the longer view. Not because people with tight budgets don't understand the value of long-term saving, but because the immediate fire is real, and it genuinely requires the available water. The cruel design of this is what Mullainathan and Shafir called the scarcity trap. The conditions that make saving difficult also make the planning that would improve saving more cognitively expensive. The people who most need financial planning capacity are in the conditions that most deplete it. I want to be precise about what this finding does and doesn't say. It doesn't say individual decisions don't matter. They do. What it says is that the cost of making good financial decisions is not uniform across income levels. At a certain floor, every decision costs more, not in dollars, but in cognitive resources. And that cost doesn't show up in any budget spreadsheet. For the woman in Columbus, the 47 days without a coffee purchase didn't just cost her $15 in restraint. It cost her a measurable portion of the cognitive bandwidth she needed to find the way out. So we have a rising cost floor, driven by policy choices, a debt trap, enabled by a fee structure the banking industry built deliberately, an income volatility problem, documented in transaction data from millions of accounts, and a cognitive bandwidth cost that the personal finance industry has never once addressed in a product designed to sell a budgeting app. Now here's the part that makes all of this worse. The same financial emergency costs more to solve at lower income levels. This is not an abstraction. It has a name, the poverty premium, and it's been documented with enough precision that it should be quoted every time someone tells a low-income earner to just build an emergency fund. A person with a 750 credit score who faces a $1.200 car repair can put it on a credit card at 18% interest or take a personal loan at 9%. A person without credit access or with a damaged credit history, often from a previous scarcity spiral, faces payday loan rates that can effectively reach 300 to 400% APR, or rent-to-own arrangements that charge 2 to 3 times the retail price of an appliance over the payment term. The same $1.200 problem. The same decision to use credit. Wildly different costs. The CFPB documented in 2021 that the Americans most likely to use high-cost credit products were also the Americans most likely to be operating near or below the income-to-fixed cost threshold. This is not a coincidence. It is a feature of how the credit market is segmented. The people who most need low-cost credit to smooth a gap are the least likely to have access to it, and the most likely to pay a premium that widens the gap for the next cycle. For the woman in Columbus, the $12 gap she stared at could become a $35 overdraft fee, covered by a payday loan at 300% APR, which becomes a fixed monthly payment, which raises her floor, which makes the next $12 gap more likely. The spiral has a starting point. The CFPB has it on file. This is the system, not a natural law. A set of policy choices, regulatory decisions, and market structures that compound on each other. And they compound in one direction. They make the floor harder to get above, the longer you're below it. The woman in Columbus isn't failing a discipline test. She's operating in a system with reinforcing pressures that don't appear in any budgeting framework because no budgeting framework is designed to name the system that makes the framework inadequate. So what actually changes the math? 3 levers, not a list of tips. 3 specific shifts that the data shows actually move the outcome. The first is the floor, not the ceiling. For earners at or near the fixed cost threshold, an income increase produces a larger structural improvement in savings capacity than an equivalent reduction in discretionary spending. The math is simple. At $333 of discretionary margin, cutting $30 is a 9% improvement. A $100 income increase is a 30% improvement. Identifying a path to a higher wage bracket, a credential, a job transition. A secondary income stream outperforms elaborate spending reduction at the margin. The personal finance industry inverts this, because budgeting apps are easier to sell than career counseling. The second is fixed costs, not variable ones. One successful renegotiation, a rent reduction at lease renewal, a refinanced debt at a lower rate. An insurance bundle that saves $40 a month permanently changes the floor. That change requires no ongoing behavioral maintenance. It doesn't reverse. Eliminating a variable expense requires discipline indefinitely and is subject to reversal under stress. 3 months of skipped restaurant meals might save $180. One fixed cost reduction might save $480 a year, every year, without effort. The math is not close. The third is a buffer before optimization. Every sophisticated investing framework built on top of an absent emergency fund is fragile. Without a buffer, any unexpected cost event forces debt, which raises the floor for the next cycle. The first financial goal for anyone operating near the fixed cost threshold is not an optimized portfolio. It is 1 to 3 months of fixed costs in liquid savings. The noise reduction that makes the system stable enough to stop consuming every small surplus in emergency absorption. Return optimization comes after the floor is stable, not before. These 3 levers are not secrets. They appear in academic literature, in CFPB guidance, in Federal Reserve working papers. What they don't appear in is the personal finance content ecosystem, because that ecosystem is funded by the products and services that benefit from individuals believing the problem is behavioral. The paper trail disagrees. October 2023. Columbus, Ohio. A woman stares at a balance $12 lower than it was a month ago. Then she closes the app. She didn't fail. The system performed exactly as designed. The policy decisions that constrained housing supply and raised her rent at renewal, those are in City Council records. The overdraft fee optimization memo that's in a CFPB enforcement file. The 2021 CFPB finding that $15 $5 billion was extracted annually through a fee structure concentrated on the lowest balance accounts. That's a regulatory document with a date and a signature. The credit market segmentation that charges her 300% to solve the same problem a wealthier borrower solves at 9%, that's in 20 years of consumer finance data. Every collapse leaves a paper trail. This one leaves several. The structural lesson isn't a list of steps. It's what the CFPB's 2021 overdraft fee investigation made plain. Below a certain income to fixed cost ratio, saving is not primarily a discipline problem. It is a fee structure problem, a zoning vote problem, a credit segmentation problem. The floor moves. The debt trap compounds. The income arrives in waves while the costs arrive on schedule. And the cognitive cost of managing all of it depletes the planning capacity that might otherwise find a way out. The personal finance industry's answer is a better spreadsheet. The paper trail says, find the fixed cost you haven't tried to renegotiate. Find the income floor you haven't yet identified a path to raise. Build the buffer before you optimize anything else. And understand that the system you're operating in was built with decisions, with authors, with dates, and that understanding it correctly is the prerequisite for addressing it accurately. The latte was never the problem. The floor was always moving. The woman in Columbus closed her banking app because nothing in it told her that. Now you know who's been raising it.